There are worse things in life than death. Have you ever spent an evening with an insurance salesman? Woody Allen. Welcome to Retirement Mentorship, your mentor to and through retirement. I'm your host, Freeman Lindy, certified financial planner. Today, we cover the insurance that you don't need, covering both the ones you do and the ones you don't, and how they fit into your financial plan. That's coming up on the Retirement Mentorship podcast. First, the 2-minute tune-in. Primary points of the podcast in about 2 minutes. We've already covered term life insurance and that you need it if you have dependents. We've also mentioned that you should consider long-term care insurance if you're over 50 and see if that fits into your overall financial plan. But what about the other insurances out there? There's a bunch. Some you need, some are optional, and some you should avoid. Bottom line is, you need health insurance, you need disability income protection, and you need home and auto insurance. You may need umbrella, and it may make sense for you to carry dental and vision insurance. What you don't need are accidental death and dismemberment policies, pet insurance, identity theft insurance, critical illness, and product insurances. We'll dive a little bit into each one and why you need it, why it's optional, or why you do not need it in this episode of the Retirement Mentorship podcast. The insurances you don't need and the insurances you do. We've already talked at length about life insurance, and so we'll leave that alone, as well as long-term care insurance. So first, let's cover the other insurances that you need. Number 1, health insurance. Obviously, you need health insurance. One of the larger reasons for bankruptcy in the United States is unpaid for medical bills. It's quite easy to rack up tens, maybe even hundreds of thousands of dollars in healthcare expenses if you don't have health insurance. You need it. Frankly, it's a big topic, and it's a topic for not only another episode, but another season. I just don't feel like going into it too much right now. There are lots of other strategies with health insurance and lots of ways that it can fit into your overall financial plan, reasons to pick one type of insurance over another. And since most people still get their insurances through their employer, we'll cover health insurance in a mini season on employer benefits and how to pick the best ones there. So for the insurances you need, first of all, health insurance. Number 2 on the insurance list that you need is disability income protection. More commonly known as disability insurance, it comes in 2 different kinds, short-term and long-term. The statistics say that 1 in 4 people will have some kind of disability claim in their lifetime. That's pretty high. And the impact of a disability can be very high financially for a family. In some cases, it can be even more financially devastating than a death in the family. Think about this. If you have a breadwinner who passes away, that's obviously bad. Their income is gone. They can no longer take care of their family. That's why we get life insurance, particularly term life insurance. We've covered this already. But if the breadwinner of a family gets disabled permanently, not only is their income gone, but they are still around, not only with their regular expenses, but also with a host of other health and accessibility expenses. And so the need for disability insurance is great. If you have people depending on your income and you want to cover yourself if you can no longer work because of sickness or injury, then you need disability income protection. There are 2 different kinds, short-term disability and long-term disability insurance. Short-term is typically 14 to 90 days. So if you get disabled, you need to wait 14 days, and then if you have short-term, that will kick in, typically paying a lowish amount of your salary or maybe a fixed amount up to 90 days. And then if you're still disabled at that point, long-term disability would kick in if you have it. Long-term disability almost always requires that you wait 90 days before it will be kicked in, so it won't cover you for a short injury. It's more of the long-term ones, as the name would indicate. And those will often cover you for 2 years, 5 years, 10 years, or perhaps out to age 65 or 67. As with anything, the studies range, but it seems like most disabilities tend to be in that 3 to 4 year range. If you become sick or injured and need your long-term disability, that's usually about how long you will need it for. But sometimes you will have people who are permanently disabled, never ever able to work again. And you can imagine the financial impact of being, say, 30 years old and becoming permanently unable to work, and the decades of income you would be giving up if that were the case. The burden is much greater. I contend, in fact, that while life insurance gets more press, disability income protection is more important for those who have dependents than life insurance is. And so while we spent a lot more time on life insurance because of the ways that permanent is sold, disability income protection is more important, and you should get that first before you get life insurance. And if you were being forced to choose between the two, I would pick disability over life insurance. There's a greater chance you will need it, and the financial impact is greater. A lot of people don't like to get it because it doesn't seem like it's as good of a product. If you pay $30 a month and then $1 million pays out if you die, that seems like a pretty good cost to benefit ratio. Whereas if you pay $30 a month and then $3,000 a month gets paid out if you're disabled, doesn't quite seem to be as fun. But you certainly have to look at the chances and impact of that happening, as well as the total amount paid out over a lifetime. Often, a disability policy may pay out even more than your term life insurance over time, just not all at once. You absolutely need disability income protection if you have people depending on your income. Many people will have access to long-term disability through their employer as a work benefit. It's popular, and you should take it if it is offered to you. Often those will pay 60% of your gross salary if you are disabled beyond 90 days, and many of them will run out to age 65 or 67, although you should check your specific benefits to find out if that's true or if it's more of a limited benefit. One thing to point out here, though, is the taxability of the benefits. Basically, what the IRS is not going to let you do is have it all tax-free. And so you have a choice. Do you want to be taxed on the premiums that you pay, or do you want to be taxed on the benefit? A lot of times in your group plan, you have that option. And so you can pick your long-term disability and then say if you want to pay for it pre-tax or post-tax. If you pay for it pre-tax, that means you are deducting the premiums for your long-term disability from your income and are paying for that before tax. But then if you get disabled, all of the benefit is 100% taxable income to you and your family. So when you think about it that way, you are deducting maybe $10 a month from your paycheck, but then taxed on 3, 4, 5, 6,000, whatever it is per month when it is paid out. It's not a lot of deduction, and that would be a lot of tax if you ever needed it. So we recommend doing the post-tax option, which is where you pay the taxes on the premiums, but then the benefit is tax-free. Suddenly that 60% goes a lot further. If you have 60% coverage through work, but it is taxable, you don't really even have 60%, maybe more like 50 or less. And so, if at all possible, pay for your group premiums post-tax. The other thing to think about, though, is 60% really enough? You're used to getting 100%. Sure, there are taxes and whatnot, and so if you're getting your benefit tax-free, then we're getting closer. You pay quite a lot of taxes on your earned income and perhaps are bringing home, say, 70%. And so if you are getting 60% of your income tax-free, you're almost at your same net income, pretty close, 60% versus 70%. But there are other things to think about as well. There are other benefits you are getting through work that you will not be getting if you're employed there. For example, if you carry the health insurance for the family and you are permanently disabled or disabled long enough that you surrender your job or that you just don't have the benefits from work anymore, you are losing your health insurance there. Perhaps the other spouse doesn't carry it, or if they do, it's much more expensive. How does that factor into your overall financial plan? Or what about your retirement benefits and the amount that your employer is putting into your retirement? Sure, when you think about it, perhaps the 60% as a take-home pay might be enough to live on. But not only are you not contributing to your 401k through work, neither is your employer, and your retirement goals stall. Eventually, that disability will run out, and if you did not have enough set aside for retirement, you will be stuck with whatever you have. Because of this, many people will need to get a gap insurance policy as well to bridge that gap between what they're getting through work and what they actually need. This is easy to calculate, figure out exactly what you'd be getting if you were disabled from work and everything you were giving up, and then figure out what kind of disability benefit you need in a personal disability policy to make up that gap. You may find that even a benefit of a couple $1,000s a month will bridge the gap and will solidify your overall financial plan if something were to happen to you. I rarely see a case where someone has group disability and that is enough, particularly if they have kids or have a very long work time horizon ahead of them. Maybe if you're a few years out from retirement, you no longer need the additional gap insurance. But certainly if you're early on in your career and you have a lot of years ahead of you to lose if you are disabled, you usually need this gap insurance. I personally have a group policy and a personal policy on top of that to bridge that gap. Again, I don't recommend things I wouldn't do myself, and don't do myself if in the right situation. And because I'm in the situation where I need disability, where I have a family that is depending on me and my income, and because my group is not enough to cover everything I'm getting through work, I need the personal gap policy as well. And so I have it. And so you need a disability income protection, preferably through work, that you pay post-tax to get a tax-free benefit, plus a gap policy to cover the gap. Go find an insurance broker, someone who can look at all the different policies of all the different companies and get you the right policy for you. Not someone who's captive and can only sell whatever their company manufactures, which may not be the best or most competitive. I'm a big fan of the 5-year benefit, particularly with companies that also have a catastrophic rider. What that basically means is that you get the full benefit for 5 years, which will cover the average disability of 3 to 4 years. But then if you end up being permanently disabled and catastrophically disabled, often these policies will then continue to pay out all the way until age 65. You get a little bit cheaper premiums than just a base benefit that goes all the way out to 65. So it makes it a little bit more affordable and still covers the majority of cases. Of course, it is possible to be permanently disabled without being catastrophically disabled, but I think that's a narrow window, and the bang for the buck is, I think, highest in that regard. I personally have a 5-year base benefit with a couple other riders and then a catastrophic rider out to 65. So, insurance you need, number 2 after health is disability income protection. Number 3 is home and auto insurance. I'm lumping these together because they are frequently sold together and bundled together, and you save money usually if you have them together. Now, not a lot to say here. Most people already have these. One thing to maybe think about, though, as you're looking at yours, is does your home insurance have a guaranteed replacement rider on it? Meaning that if your house is destroyed, do they guarantee that they will replace it regardless of how expensive it is to replace it? In some of the other policies, they have a certain dollar amount. We will cover your house to $250,000. And if it costs $240,000 to rebuild your house, then you're great. But what if, especially now with the ballooning prices of lumber and other construction materials, what if it now costs more than it used to replace your house? Perhaps you had a house that was worth $250,000 and it would take $250,000 to replace when you first got your policy. But now with the ballooning construction costs, might cost more like $300,000 or $350,000 to replace. If your coverage is still for only $250,000, then you are not really fully insured. So one thing to check on is to see, do you have guaranteed replacement on your homeowner's insurance? As far as auto goes, one of the classic mistakes we see is people with the wrong coverage. There are basically 2 different coverages in your auto insurance. One is a per person, and then the other is a per incident. And it's usually a number / another number. So for example, we see a lot of people with $100,000 / $300,000 coverage, meaning that if they are liable for an accident, if you hit somebody else, the insurance will cover your liability up to $100,000 per person and $300,000 per incident. Now, if you are texting or whatever and you smash some other car and it's full of people and it's your fault, it is very, very easy to do more than $100,000 of damage per person. We were talking about that a little bit with health insurance, that health costs can balloon very quickly. And if there are multiple people in the car, running up over $300,000 per incident is also quite easy to do. This coverage has been around for a long time, and perhaps when it came out, it made sense, but it hasn't really moved much in a few decades. And so while that may have been enough back in the 90s, it is certainly not today. You'll want to make sure that you have at least $250,000/$500,000 of coverage, meaning $250,000 per person, $500,000 per incident. And that will give you a much greater breadth of coverage if you are liable in an accident. You can pair that with umbrella, which we'll talk about next, but double check that in your insurance right now. It does not matter how much financial planning you do if you're uninsured in the auto department and you get an accident that is deemed to be your fault. Suddenly, if you've done $750,000 worth of damage in an accident and you only have $300,000 of coverage, no amount of investing or retirement or tax planning is going to make up that $450,000 that you now owe in a lawsuit. So make sure you have the right coverage. This is pure insurance. You need the right insurance. Get $250,000/$500,000 of coverage on your auto and guaranteed replacement on your home. Most people already have these insurances, but a couple things to look for there in the insurances you need. Now onto the optional insurances. Umbrella is the first one. Umbrella insurance is basically additional liability insurance over and above what you would have with your home and your auto insurance. So we talked about that a bit with auto. If you do $500,000 of damage, a $250,500 policy will cover it. But if you do $750,000 of damage, now you're underinsured again. And so putting a $1 million umbrella over top of it will cover you for an additional $1 million of liability, putting you at $1.5 million total if you're liable in an auto accident. Homeowners insurance also carries a certain amount of liability insurance with it. So if someone gets hurt on your property, it'll pay for it based on the terms of the policy and maybe after meeting some deductibles or whatever else is in there. But umbrella can then raise the bar on that and give you more coverage. If you are anyone at all who hosts a lot or who goes out or worth any amount of money, then umbrella is usually a very good bet. It's pretty inexpensive, maybe $70 to $100 a year. A very easy add-on to an overall bundled policy. And so it is a good thing to look at, inexpensive. Some people may not need it, but I have it, and I think it's a good thing to get for most people. The second one in the optional insurance category is dental. If you do the math on dental and you are some of the people that just do your basic cleanings twice a year and not much else happens, you basically about break even on dental insurance. Meaning that it kind of forces you to go twice a year because they always want to get that scheduled. But if you look at the premiums you're paying versus what it actually costs to just go pay cash to get cleanings done, it's about the same. If your employer is picking up a bunch of the cost of dental, then obviously it's going to make sense to take advantage of that. But if they're not, or if you're paying quite a bit, you can just do some of the math on that. And it's usually not that great. Obviously, it helps cover some other things, which may help. But what we see a lot is people who are paying quite a bit for dental insurance because their employer is not picking up a lot of it and then never go. Right? If you never go to the dentist, then you're paying for something that you don't even need and aren't using. So that's why it's in the optional category for me. Similar with vision insurance. Obviously, it covers you for some of these catastrophic things, but again, a lot of people may need it to go if they have a lot of eye issues. Obviously, if you don't have any eye issues, you don't need it. But if you actually do the math on it, again, a lot of times you're paying, $25 a month to get $250 off your frames at the end of the year. So it honestly is optional. I need contacts, and I just basically go every other year with or without vision and save a little bit of money there because I don't feel like I personally need to go to the eye doctor every year. My prescriptions have never changed. Obviously, there would be some people that do, their eyes are changing and want to go in more often than that. So not needed, not unneeded, optional based on your situation. So optional insurances are umbrella insurance, dental insurance, vision insurance. Calculate those based on your situation, whether you need them. Now on to the not needed insurances. The popular things that are out there available and sold to people that, in my opinion, just don't make sense and are kind of a waste of money in an overall financial plan. Obviously, with these, you can waste your money on whatever you want, and it may not be any better to waste your money on unneeded insurance than anything else. There's a lot of things that we do that we spend money on that don't actually happen, but that make us feel more secure. So if you get an immense amount of security knowing you have these things, then great, get them. But if you never think about it one way or another, then it may just be a waste of money for you. First on the list would be accidental death and dismemberment insurance, or AD&D. These is kind of like life insurance, except it only pays out if you die in an accident, not if you die from a sickness or a disease or a health-related issue. Now, this does happen, but honestly, the majority of deaths in the United States, and I'm sure the world, are based on disease or health issues or other things, not on accidents. Not very many people die from accidents, although it, of course, does happen. The correct financial planning solution is to just get the right life insurance. Especially if you're healthy, the right term life insurance is often cheaper than AD&D to begin with and can provide you the right amount that you need. And then you're covered for all things, whether you die in an accident or not. So that would be the right thing to do. The exception for the AD&D might be if you're uninsurable, but still have people who are dependent on you. For example, maybe you had a heart issue as a child, and now you cannot get life insurance other than the ways we've talked about, getting it through work and whatnot. But maybe you exhausted all your work options and you don't quite have enough. Stacking an accidental death and dismemberment policy on top of that may be a good option so that you are fully covered if you were to go in a car accident, something like that. So it can be a good option for some people, but a lot of people just have it tacked on at work and are paying for it, don't really notice. And it could be a way to save a few $100 a year and put that towards the right term insurance instead of wasting it on something that's only half covering you for death. Be fully covered no matter how you die, not half covered and limited to a certain way of dying. So AD&D would be on the not needed for most people with a few exceptions. Number 2 on the not needed list is pet insurance, usually a complete waste of money, highly profitable for insurance companies because people don't usually use it. Obviously, you might have a very unique case where it makes sense, but the vast majority of people don't need pet insurance. Number 3, identity theft insurance, similar thing. This is often preyed upon about all the problems with identity theft and how high it is and how often it happens, and you need this insurance. Look, you could be completely covered and smothered in insurance if you want to. And again, if you get a lot of security out of it, then maybe go for it. I don't carry it myself. And if I don't do it, I don't recommend it to people. It's kind of my rule of thumb. Another one would be critical illness insurance. These are insurances that pay out a lump sum if you get a certain critical illness. So for example, if you have a heart attack or a stroke, maybe they'll pay out $10,000 or $15,000. These products are also highly profitable for insurance companies because they don't pay out that often. So again, if you have the right health insurance and then the right life insurance, if the worst happens, you should be good. There are other financial planning strategies around being ruined by a critical illness. And you can cover those in other ways that don't leave you high and dry if it never happens. And so I don't have it, don't recommend it. And then product insurance. You might see these with phones or when you buy TVs and those types of things where they offer you purchase protection plans and insurances and all that. And let me just tell you this. I worked at a large retail store where we had a target sales back in the electronics. And the target, though, was not on how many TVs we could sell, but on the amount of insurance plans we could sell on these TVs. Because the store and the company didn't make any money on the TVs. They made all their money on the insurance policies of these because people will buy them, forget they have them, lose the confirmation that they have them. And the electronics almost never die within the time period. And 2, even if they do, people often forget they have the insurance. So these are a riot for the insurance companies and kind of a waste of money. So if you want to save a few $100 a year, put that money towards one of the more important insurances. All these not needed insurances, of course, are totally up to you. If you really want to get them, go for it. But you for sure need health, life if you have dependents, disability income if you have dependents, home and auto, fully covered, and umbrella. And I would spend money on all of those before I'd pick up a single one of these not needed insurances. So there you go. Out of all the insurances out there, now you know from a financial planning perspective which ones that you need, which ones you could have depending on your situation, and which ones you can avoid and save some money. Put that to better use in your overall financial plan, either by getting the right insurances or by investing it, or maybe by just enjoying that money a little bit with your family and loved ones. That wraps up not only this episode on insurance, but also this mini season 2 on insurances. Wanted to get this one out of the way so we can come back to it, send people back to it when they have questions about insurances and which ones they should have. And now you know, insurance, in my opinion, is one of those things that you can just look at once, take care of it, get it done. Of course, it's important, but then you can move on to the more fun things, kind of a set it and forget it, and move on to the amazing parts of financial planning, which I'm excited to get to next in the next season, which is coming up here before you know it. Coming up in the next season of the Retirement Mentorship Podcast, we'll look at all kinds of different things, including does your personality affect how you handle money and other behavioral finance topics. We'll look a little bit more at your mortal enemy, inflation, and especially with all the stimulus and packages that are coming out these days, how dangerous is inflation and what can you do about it? And we'll look a little bit further at the absolute stupidity of investing based on your risk tolerance, the trouble with target date funds, and how to tip your server, not the IRS. That's all coming up on the next season of the Retirement Mentorship Podcast. Looking forward to it. We'll see you next week. This podcast is educational only and is not intended to be investment, legal, or tax advice or recommendations, whether direct or incidental. Again, this is not investment advice. Consult your financial, tax, and legal professionals for specific advice related to your specific situation. Never take investment advice from someone who doesn't know you and your specific situation. All opinions expressed in this podcast are the opinions of the speakers expressing them. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Retirement Mentorship is not affiliated with or controlled by any registered investment advisor, broker-dealer, or other financial services company.